So, last time we were talking about mutual fund, where to invest your money. So today, we'll talk about mutual funds and little bit about stocks also, how to identify the best stocks. Uh, so we'll understand that, okay? If you have to invest in stocks or if you have to invest in mutual funds, how to choose a stock or a mutual fund, okay? So as I told you that there are five categories in mutual funds: equity, okay? So we have, the equity, hybrid, debt, solution oriented, and others. Okay. So what we'll do, we'll cover equity and we'll cover debt. If we cover the both, then others are automatically covered because the hybrid is debt and equity both mix of that. Okay. So we are doing this equity and we'll cover debt also because that is also very important. So most of us want to put some money in fixed income securities also. Okay. Um, So equity is, I talked about, there are various kinds of funds and I explained also, it's there in the video. So we talked about, like large caps. Then we have, mid caps and small caps and then various kinds of categories. Okay. So we went to large caps. Okay. So we found that we got, all these mutual funds which are under the large caps. These are all the schemes. There are approximately, I think, 35 schemes in India which are currently there. So if you want to know, first of all, there is a ranking done by CRISIL, a rating agency. Okay, so if you can, you can even sort it by 5 star, 4 star, 3 star. Okay, so if you want to invest only in a 5 star fund, which means that it has been, like Nippon India, which will find that it is giving the maximum return over the last few years. Okay, so what we can do is we can just download this data. इसको download कर लेते हैं. So we download, and if you're having a laptop and Excel, you can download. You will find it. Otherwise, you can watch it. Okay. So then, once you have downloaded it, so you will have all the large cap schemes, okay, with you. So there are about, if you go down, there are about 35 or 34 because it starts with the first line is the 33. Okay, fine. So what I'm doing is as I'm just removing the top line, which is the header. Fine. So I don't need, and it's a direct plan. Actually, when you can buy directly from the fund house or you can buy from a broker. So it is always advisable to buy. I mean, you can of course buy from a broker or as well as a direct plan. It all depends upon you on this thing, but you will get a little less return if you buy from a broker, almost like 1% less. So this is. So to buy these funds, better to go to the website and make purchase. हाँ जी. मैं निपुण की वेबसाइट पर जाऊँ. हाँ. वहाँ से purchase. Give your PAN number and give your bank account number, and register yourself, and then you can buy it from there straight away. But if I register CMS, then I will get access to everything. You will get everything will come to your that account that you are talking about CMS. हाँ वहाँ आ जाएगा. No, actually, you see, जैसे Nippon है, so you go to Nippon Mutual Fund, okay? So this is, if you have to buy a Nippon one, you have to go here. You have not gone to the money control. हाँ नहीं money control में गया था, but sir was asking that if I have to buy, Nippon, so go to Nippon India Mutual Fund. So this is the site from where you have to buy. So you give your PAN number and link your bank account, and they'll register you, and you can immediately start buying it from here. Instead of going anywhere, don't go to anywhere. हाँ, everything. हाँ, then we went to the money control. Okay, fine. So you go to money control and select the large cap and download. And there are direct plans and regular plans. So choose the direct plans. What are the differences? Difference is that you are buying directly from Nippon. You go to this site and buy it from Nippon. So this is direct. But if you go to, you have your bank account, so they'll say there will be a tab to invest. So you press, suppose you're having ICICI Bank. So in the ICICI Bank, this thing, you will have a tab to invest. So you can choose that. So that will be indirect. So that means you are buying through ICICI. Through it will be less return. Less return. Yeah. That is called regular. That is called regular. Okay. So if you go to this thing, First, we are talking about returns direct. Okay. Yeah. Absolutely. If you buy from broker, broker gets a commission. Okay. I'll just show you also. I'll show you what is the difference of return you get when you buy directly or from a broker. This thing. So what we have done, I have just downloaded this. I have downloaded this. So just download whosoever is there. जिनका लैपटॉप है डाउनलोड. हाँ. So, this is, I'll just show you. So this is, no login, free. So what I'm doing is I'm just, taking a copy of this and send it to, so you can just circulate. Okay. So I'm just saying is that I'm just sending the link. Okay. Because otherwise you have to just remember the site. हाँ, वो आपको उसमें क्या है कि यू हैव टू गो टू एड एक्सटेंशन, एड ब्लॉकर. ओके. एड ब्लॉक का एक इसमें डाल दीजिए आप, एक सर्च करके एड ब्लॉकर है, एंड देन यू कैन ब्लॉक इट. ओके. It is also paid also, and it's a free also is there, version is there. So what I have done is I've taken a large cap here. Okay, fine. And then I downloaded the large cap. Fine, download. इसको डाउनलोड कर दो आप. क्या नहीं दिख रहा? लार्ज कैप. हाँ, स्लो. So we are here. So it is moneycontrol.com mutual funds.
ये जैसे हम वहाँ पे हैं अभी.
हाँ.
मैंने इक्विटी में करा.
हाँ.
अभी लार्ज कैप और ये वाला ऑप्शन कहाँ है सर? कुछ तो दिक्कत है.
हाँ, कुछ तो दिक्कत है.
यहाँ पे आ रहा है ना आपका?
हाँ, यहाँ आ रहा है, बट वो आपका ये फिल्टर कर दो.
वो हटा दो. ये तो आ रहे हैं सर, ये 3 8.
तो आप कोई भी डाउनलोड कर लो. फिलहाल कोई भी डाउनलोड करो. प्रोसेस इज सेम. ओके, फाइन. आर यू गेटिंग दिस मोस्ट ऑफ यू, और यू जस्ट आप गए तो सही हो बिल्कुल, मतलब इट्स नॉट दैट यू आर एट द राइट प्लेस ओनली. हैव यू गॉट दिस स्क्रीन? Yes. आपका भी नहीं आ रहा. आपका आ रहा, कौन सा आपका आ रहा? See, I'll just show you again. Fine. So मैंने जो लिंक भेजा है आपको, उससे आप चले जाओ. कल से आपने शेयर कर दिया लिंक. So link has been shared. So take that link. And from that link go to the right place. आ गया आपका लार्ज कैप? आ गया. आपका आ गया बिल्कुल नहीं. उस लिंक को सेव कर लो आप. हाँ, परफॉर्मेंस म्यूचुअल फंड, परफॉर्मेंस ट्रैकर, देन रिटर्न्स एंड इक्विटी. आ रहा है. चलो, अच्छा है. मैं तो परमानेंटली सेव करा हुआ, आई ऑलवेज गुड. सो अच्छा. हाँ, या इक्विटी में जाके, इक्विटी में देयर आर 5 टाइप्स ऑफ क्लासिफिकेशन म्यूचुअल फंड्स. सो यू गो टू इक्विटी एंड प्रेस द लार्ज कैप. सो देयर आर 13 सब कैटेगरीज इन इक्विटी. ओके. सो गो टू लार्ज कैप एंड सिलेक्ट डायरेक्ट प्लान्स. ओके. यहाँ डायरेक्ट भी है, रेगुलर भी है, एंड देन डाउनलोड. ओके. सो व्हेन यू डाउनलोड, सो आई एम जस्ट अगेन डाउनलोडिंग इट. हाँ, फिर डाउनलोड कर देना. And then what I have done is I have deleted this.
What have you deleted, sir?
The top line. अब होता क्या है, when so many people are using the same, going to the same site, sometime it doesn't give you the complete data at times. ऐसा होता है कभी. Anyway, because I'm using my own personal hotspot, but you all using your the Wi-Fi. If you हाँ, अगर आपको दिक्कत है आप personal hotspot से कर लो तो better रहेगा. Okay. So then the B column deleted. B and हाँ B and C both ये कर लीजिए delete. Because one says large cap and direct plan, so we know everything is direct. So I'm going to delete that. So I'm just going to look at a very data in a very orderly fashion. So anything which is extra, I'm deleting it. हाँ जी. हाँ मतलब वो मैंने डायरेक्ट प्लान और हाँ कैटेगरी की नेम उड़ा दो. ये तो उड़ा दो. नहीं एक्चुअली क्या था, अब वो चेंज हो गया ना. मैंने क्या करा, डिलीट कर दिया तो ऑटोमेटिकली रीएडजस्ट हो गया. हाँ हाँ देखो मैं आपको बताता हूँ. हाँ. देखो ये चीजें आ रही थी पहले डायरेक्ट प्लान, ये सब डायरेक्ट प्लान है. वी हैव डाउनलोडेड डायरेक्ट प्लान. नहीं 1 to 6 मैंने डिलीट नहीं करी, कोई डिलीट नहीं करी मैंने. अच्छा आप ऐसा करो, एक सेकंड, आप यहां से चलो, निपॉन आ रहा है ना आपका एंड जॉब, तो 33 आ रहा है. 33 स्कीम्स आ रही है. 34 इंक्लूडिंग द टॉप लाइन. टॉप लाइन निकाल दी आपने. सो देर आर 33 स्कीम्स. 33 आएंगी आपके पास. There are 33 large cap schemes. If you are getting, then you are at right place. So मैंने ये डायरेक्ट प्लान डिलीट कर दिया and I'm deleting the large cap. Okay, because I don't require, this is an extra information. Okay, fine. हो गया सर आपका. सर का क्या नाम है, भूल जाता हूँ सर. नहीं सर, मारवा सर, मालवा, वाधवा वाधवा वाधवा. ओके गुड. सो वाधवा सर हो गया आपका. ओके नाउ ये आ गए हम यहाँ पर. व्हाट आई एम डूइंग इज नाउ आई एम जस्ट सिलेक्टिंग एवरीथिंग. इसको सब जो है लास्ट कॉलम तक, एम कॉलम तक, जहां तक आपकी वो आ रही है, इसको पूरा सिलेक्ट कर लिया आपने, इसको शेड कर दिया. ओके एंड कंट्रोल टी इकट्ठा दबाइए तो आपके पास ऐसे आ जाएगा. ओके एक सेकेंड सर, एक सेकेंड. मैं हाँ ये जो स्कीम नेम था ना, ये रहना चाहिए था आपका, ये रहना चाहिए. हाँ ये स्कीम नेम इसके नीचे आएगा, वो डिलीट कर दिया हमने. ऊपर सबसे ऊपर स्कीम नेम आएगी, मतलब हेडर होना चाहिए, ये हेडर्स रहने चाहिए. हाँ अब मैं ये स्कीम नेम से चुन के और 10 ईयर तक एंड तक ले गया. ओके एंड कंट्रोल टी. It should have an header. It says that where is the data for the table? My table has headers. Okay, it has. Fine. तो ये आ गया आपके पास. इतना हो गया सर. ओके अब इसको थोड़ा सा आप चाहो तो अपना हिसाब से कलर जो आपको अच्छा लगता है वो बना लीजिए. फाइन. लाइट कलर कर सकती है. जनरली आई ऑलवेज लाइक दिस कलर. फाइन, क्योंकि ये दिखाई दे जाता है. बट इवन दिस कलर इज ऑल्सो गुड. फाइन. इट्स ऑल अप टू यू बेसिकली, योर ओन दिस थिंग. So you have got this. So you can have your own color, whatever. It doesn't make any difference. Again, now first is scheme name. So okay, now you can sort it on screen basis, scheme name also. तो A से लेके Z तक आ जाएगा sort होके. Suppose you are looking for a particular fund, so you have to track it. So it will start with Aditya Birla, Axis Blue Chip, Bandhan Bank. So it is in alphabetically order. Okay, so you can always choose. And suppose you want as per the ranking के हिसाब से आपने select करना है, तो इसको ranking के हिसाब से भी select कर सकते हो आप. Okay, so because there are certain schemes which have no ranking, so you can put 0 here for the where there is no ranking, and then again sort. So it will start with the 5 star on the top. जहां पर वो कुछ नहीं आ रहा था, डैश डैश आ रहा था, make it 0 0 0. कॉपी पेस्ट जीरो कर दो, एंड देन नाउ दो स्कीम्स विल गो एट द बॉटम. ओके. ओके, ये वाला. हाँ. हाँ, ये मैंने क्या करा, व्हाट आई हैव डन इज बेसिकली आई पुट अ जीरो हेयर एंड देन कॉपीड दिस जीरो हेयर. Okay, and then again sorted it. So now I'm starting with 5 star at the top. जो dash dash थे, those schemes are not rated, so they are coming at the top and then followed with 5 4 3 2. I pushed it down. Okay, fine. AUM is asset under management. That means total money which the investors are given to the fund and which has grown over the time. Okay, so this is the amount of money which they're having, and with the appreciation happening over the time also. Okay, so is that okay? Then because equity investing is a long term game. Okay, so what we do is that we sort it on 10-year basis. अब 10-year basis पे देखते हैं, यहाँ पर भी आपको कुछ कॉलम्स आ जाएंगे जीरो. तो यहाँ पर ऑल्सो यू पुट अ जीरो हेयर एंड कॉपी दिस एंड अगेन सॉर्ट. So you will have, in a 10-year period, which fund has given you the maximum returns. So it will tell you. Okay. So in 10 years, a fund, Nippon has given 18% return, isn't it? So Nippon is on a 10-year frame, it is the best fund. So what I'm doing is I'm just putting uh, you know, I'm putting a marker here. I'm putting a yellow marker here. In a 10-year frame, this fund is giving the top. Now I can sort it on 5-year basis also and see on a 5-year basis. So I'm again going to put zero here. And copy this zero everywhere. So abhi ho gaya. Okay, and then again sort. So then in 5 year it is Canara Robeco. Okay, so I'm just making a marker here. But agar both funds have given, Nippon and Canara are giving the same returns. Okay, so I'm marking everything yellow here. Maybe there will be some difference in points, so we can always look at the difference also. Okay. No, I'm just saying in 10-year period, which is given the maximum. In 5 year, which has given the maximum. Okay. Which is Nippon. And 5 year also it is 18%. So we can always, see the return. So it is actually like this. Nippon has given 17.92% and Canada has given 18.17%. That's why it's coming at the top. Okay. हाँ, 5 year में कैनरा इज बेटर. हाँ, थर्ड ईयर में देखते हैं. थर्ड ईयर. हाँ, अभी आ रहा हूँ मैं. वाईटी भी बता रहा हूँ. वाईटी इज मतलब फ्रॉम जनवरी टिल आज की डेट तक. So again on third year basis it is again Nippon. Fine. 3 साल के बेसिस पे भी निपॉन आ गया. 3 and 10 निपॉन इज इन लीडिंग एंड 5 year it is Canara. But now Canara has gone way below. Okay, in 3 year. Now look at 2 year. एक बार हमें 2 year भी देख लेते हैं. So 2 year में 0 0 0. Okay, and then again I sort. So second year में कौन सा आ रहा है आपका? हाँ. So Nippon, if you look at Nippon is coming the top, isn't it? So you have to select, which is the best fund from 2 year horizon, 5 year horizon, 10 year. So you can do it for 1 year. You can do YTD, which is year to date. That means right from January till December 8th or whatever is today's date. So Nippon is the fund which is actually having, it's a 5-star fund. Okay. Then HDFC, if we look at, HDFC is, in 3 year time frame, HDFC second, then ICICI Prudential. Okay. So let's go to 6 months. Okay. Quant is coming at the top, 6 months. YTD is year to date. That means January till 8th of December. It's almost like 11 months and few days. Okay. So quant is doing better in 1 year time frame. Is, abhi, I mean, recently started performing well. Quant, हाँ quant जो है ना, it has started just recently. It is 000. Second year में zero है, third year में zero है, fifth. That means a new fund, new scheme. So it's a new scheme which has come and started outperforming everyone. If you want to make an analysis, कि this was not there, 2 साल के horizon में तो quant थी नहीं, अभी आई है. So quant is giving in 1 year time frame, quant is giving 21%, whereas Nippon is giving 25%. हमने क्या देखा था 6 months time frame में था. 6 month time frame में Nippon is giving you 24, whereas sorry, Quant is giving 24 and Nippon is giving 70. Now this is one way of looking it, but this is not the ultimate way. Okay, the best way to look is basically to go to risk ratios. आप वापस जाइए एक बार यहाँ risk ratios में, go to risk ratios. Now it has become risk ratios में go and download risk this thing. ये risk थी. So again the same problem is coming. Anybody is getting the risk ratio complete detail आ रही है? Because so many people are using, so maybe that it is becoming little bit. आप equity में गए, large cap में गए, okay, and then went to risk ratios. आ गया? इसको डाउनलोड कीजिए आप. ये आपका डेटा यहाँ नीचे आ जाएगा. हाँ आ गया, मेरे पास भी आ गया रिस्क. एंड डाउनलोड. So I have downloaded. Now this is an ultimate. आपने जो whatever decision you have to take based on this. The first was just to have an understanding about what kind of return it is giving. Fine. Okay. So what I have done, I have just downloaded this risk ratios. So this will give you a complete picture. Okay. You don't have to do anything. Look at this only. Okay. हाँ इसको मैं आई एम जस्ट डिलीटिंग द टॉप लाइन. ओके एंड कौन सा मैं लेक्चर में हूँ अभी करता हूँ कॉल आपको थोड़ी देर. So I am just deleting this also. Fine. So now हाँ वो हटा दीजिए. So you have now Chrysler rank, standard deviation, beta, sharp ratio, Jensen alpha, and trainer ratio. हाँ download the risk ratios. Download the risk ratios. Have you? आ गया. अब इसी को वापस सिलेक्ट कीजिए आप और कंट्रोल टी कर दीजिए. So reach to this level. I'm just waiting. I'm not moving ahead. हाँ जो डायरेक्ट प्लान है सब कैटेगरी है, डिलीट दैट. डन. ओके. नहीं अभी मैं बता रहा हूँ. आ जाओ यार, अभी बड़ा इंपॉर्टेंट वाली चीज कर रहा हूँ, यू विल मिस इट. Okay, so there are two very important things. We whenever we invest in equities, we are taking risk. Whenever we are investing in mutual funds, which represent equity, there is a risk. Now, risk can be looked from two angles. Okay, how do we measure risk? Okay, how do we measure that risk? Now, there are two statistical measures through which you can measure the risk. One is called beta, and another is called the standard deviation. Now, standard deviation is nothing but volatility. How volatile is a stock or how volatile is a mutual fund? The more the volatile the mutual fund or stock is, more risky it is because it keeps fluctuating. The more it fluctuates, it will be more risky. Now, whenever we say the volatility, we refer from the mean. Okay, suppose a stock is giving you or a mutual fund is giving you say 15% return, or like Nippon is giving 18% return on an average. Now, sometimes it is giving 16, sometimes it is giving 19. Sometimes it can give even 10. Sometimes it can give you 25. So more the volatile it is, more risky it is. So less volatile it is, it's always better, isn't it? जितना कम volatile होगा उतना अच्छा होगा. So standard deviation actually measures, uh, it's a total risk. Standard deviation measures the total risk. Now listen to it very carefully. There are two kinds of risk whenever we invest in equities or mutual fund. One is called the company specific risk. Okay. Another is called the market risk. So I'm just putting it here. So the risk we take, we say total risk. What risk I'm taking? For everything. So one is called specific risk. I can say company specific risk or mutual fund specific risk. But I'm saying company specific risk here. And second is called the market risk. So whenever we invest our money, we take two kinds of risk. Okay, and this can be also called macro risk. Macro, and this is micro. Specific to the company, and this is the specific to the economy. Okay, fine. So company specific risk. So just to give an example, about 15 years back, around 15 years, I think, I bought a stock Maruti Suzuki. Okay, it was trading at 1,000 rupees. And the whole analyst was saying that it will do very good. And it went to 10,000 also, okay, recently. And it's close to 10,000 now also. So, I bought it at 1,000, 1 lakh rupees. But after a week, there was a strike in Manesa. There was some, workers' agitation, and somebody died also, the worker. And Maruti closed down, shut down, or the plant was shut down in Manesa. The stock went tumbling. It came from 1,000 to 500 rupees. So I have invested 1 lakh rupees in a week's time, it became 50,000. So that was the company specific risk I was taking because I was not knowing what is going to happen to the company. I couldn't think about that there will be such kind of a thing. And nobody told me, and when I was reading the newspapers, I didn't find there was any news till that time. But then the company was, because the market doesn't like uncertainty. So nobody knew when the Maruti is going to open again. So it fell down to 500. So that risk is called the company specific. Anything can happen to the company. Company can, adopt a strategy. It may fail. Okay, because of the company's own reason, if the stock goes up and down, it's called the company specific risk. Is it okay? Now, the second risk, which is called the market risk. Basically, because of the, if the economy is growing, if it is a good, monsoons, and the interest rates are coming down, and the cost of capital is also coming down, and companies are expanding their businesses, the economy is looking good. So we may face a situation where the economy is doing well. Sometimes the economy is not doing well, it's in recession. Sometimes it's in boom. So in boom time, you'll find all the stocks are going to go up. The degree at what they go will depend upon each stock, how it is going, the economy is going to impact them. Suppose if the interest rates come down, Maruti is going to do well. All white goods, real estate stocks will do well because when the interest rates goes down, people borrow money, people take loans and invest in buy cars, buy white goods, buy go because the EMIs are becoming cheaper, so it affects the company's profitability. And when the interest rate goes down, the company who has taken loans, they also have to pay lower interest because generally company takes loan on a floating rate. If the interest rate goes down, their interest liability also comes down and their bottom line goes up. So company make more profits. Okay, so that kind of a situation which is propelled by the economic indicators. So when the economy is doing good, all the stocks rise. When the economy is, doing bad, all the stocks fall. Now, it will all depend upon, the degree will depend upon, how the economy affects each stock. Okay. Now, there are certain stocks, just to give an example, there are two kinds of, or, if you classify the products the companies are making. One is called discretionary products, like cars, white goods, housing. These are discretionary. We use our discretion. We can always postpone our decision to buy a house or a car or automobile. In a bad time, we will not do that. When the interest rates are rising, we will not do that. Okay. But when the interest rates come down and the economy is booming, our incomes are going up, everything looking very rosy, we keep buying those products and those companies do well. Okay. So, and it will be the vice versa when the economy is not doing well. Now, other types of categories, consumer products, FMCG companies, consumer staples we call them. Okay, so those companies are not so much affected by the economic ups and downs. Like Hindustan Unilever, Colgate, we'll keep buying their products. Even if the state of economy is not good, because what they're doing it, they're selling products which are normally used by all of us. We don't look that the economy interest rates have gone up. I'll not buy shampoo or something. So those companies will always do better, even if during the recession. Okay, so market risk can affect the company's performance or a mutual fund performance because mutual fund is also investing in companies after all. So there are two kinds of risk: company specific and market risk. Now this risk is captured by standard deviation. This total is captured by standard deviation. This total risk is captured by one, statistical measure which is called standard deviation. Okay. Now, suppose I say there are two stocks, stock X and stock Y. Okay. Now, what we do, we calculate the mean return of the two stocks. Last, say, 5 years, for example, how do we calculate a mean return? Say for last 10 years or last 5 years, how much return a stock is given, we divide by 10. So we find that the return is 15% here and 20% here. So stock Y is given on an average 20% return historically, and X is given 50%. So one simplest way is just calculate the returns for the last 10 or 15 years and divide and calculate a simple mean. Or some people, just try to, because there's a historical return. Okay. Sometimes people say the historical return may not be repeated again. Okay. So they predict, the boom, recession, stable period, normal this thing, and they find out the probability of each event. And under each event, what kind of return the stock is given. And then they really calculate the mean return basis of the probability distribution. So there are various ways. Of course, we can't, we can only calculate return through looking at what has happened in the past. Okay, fine. So this is 15 and this is 20. Unless the company has changed, the return will be the same. The company's business has totally changed, or company has taken more loans, then company may become more riskier. So we have to make some adjustments because of that if you want to make. Otherwise, you can take the average return the company has given from last say 10 years, so it will get. But you don't have to calculate that. I'm just telling you. Okay. So this is 15 and this is 20. Then the second thing which you look at is the standard deviation. Now this stock is standard deviation is say 20%, and this is 30%. Okay. So The higher the standard deviation means this stock is more volatile, this stock is less volatile, isn't it? Okay. So if you have to, without looking at this data, where you will be putting your money? Why? Because Y is giving you 20% return, isn't it? And X is giving only 15%. So you will say, I'm going to put in Y. But the second thing which you should ask is how risky the stock is. So you put the risk parameter here, 20 and 30. So now what you do is you divide 20 by 30. So you get 0.66. Okay. And you divide 15 by 20. You get 0.75. Okay, fine. So this is return per unit of risk. Return per unit of risk. So here you are getting 0.75. Here you are getting 0.6. So you take 1 unit of risk, you get 0.75 return. Here you get 0.66 return. So which is better? Then you will say that this stock is better, isn't it? Because here your return per unit of risk is better, isn't it? I guess. This is hypothetical. I am just giving an example. But I told you there are a couple of ways through which you can calculate the mean return if you want. They are available. But still, if you want to know what is the mean return I want to calculate, just check what's the return. Suppose Reliance is given you over the last 10 years. In each year, how much return Reliance is given? Sometimes it is given, like this. Suppose, this is Reliance, for example. 1, 2, 3, 4, 5. These are real years. Okay. Reliance is given you minus 10% return in the first year, plus 30% return in the second year, then plus 5% return in the third year, and then plus, another 5% return here, and then minus 5% return. For example, this is the case. Okay. So what we do, just simply add them. तो ये तो दोनों कैंसिल हो जाएंगे 30 and 25% आ गया. Is it divided by 5? How much is getting? Suppose I say it is 15, it is 15. So this will be, or I say this is plus 5. Now just calculate again. What is the mean return you are getting? 11% return. So we say Reliance is giving 11% return on an average. So we add them up last 5 years and divide by 5. Okay, fine. So this is the mean return. So sometimes the stock can give you a minus return, sometimes it can give you as high as 30% return, isn't it? But average return is 11%. Okay, I'll just tell you one thing now. Yeah, yeah. नहीं अभी मैं आता हूँ उस डेटा में जो डेटा शीट है वो डेटा शीट जो है एवरेज आ रहा है. We'll come to that. Just don't think about that at the moment. Just understand this concept. Then I'll relate this thing with that also. So I'll just tell you one, a small thing. Think that there is a river, 1 kilometer long. Okay, it's a 1 kilometer long, and the height, average height is 5 feet. Okay, and you don't know how to swim. Right? So will you take, and it is standing anywhere, any part of the river, okay, in 1 kilometer. If you take a dip in that river, will not die. Ask one more person. In the standard it is 0. It means it is 5 feet flat. It's like a swimming pool. But when I say it is, the standard deviation is 20%. If I say the standard deviation is 20%, okay. So what does it mean? So it is basically 5 feet is the depth, and standard deviation is 20%. Okay. Now we all, there is something called normal distribution. Okay? We always assume that everything is normally distributed. Over the time, everything gets normally distributed. Okay? But that assumption can go wrong also. Fine. So it is 5 feet plus minus 20%, which will be 6 and, sorry, 5 and 6. 4 and 6, sorry. 4 and 6. Okay? So that means one standard deviation plus and minus. The river can be 6 feet deep also and can be 4 feet deep also. The chances of this is 67% if we follow the normal distribution. अगर normal distribution है तो 67% chance है that will be between 4 to 6. Then it can be 5 plus minus 2 standard deviation, 40%. So 5 कितना हो गया? यहाँ कितना है वैसे? 3 to 7. So this is 95%. Okay. Then 5 plus minus 60%. That means 3 standard deviation. Just calculate. 2 to 8. This is 99%. Fine. बस यहाँ तक होता है. Fine. So we can keep calculating up to 4 standard deviation. It will never reach 200. Okay. But we just calculate that this is 5 feet. Okay. Will be, if even if I am 5 feet, 5.5 feet, or below 6 feet, I don't know how to swim, so I am not surviving. So it will be, because I don't know, in the river, I may going to the place where it is 6 feet deep, and so that is 67%. But it can go to this also. So there is a very little chance that I will be safe, even if the height is average 5 feet. Have you got it? Now stock market is like that. When we say that the average return is say 20%, sorry. Suppose I take two stocks, X and Y. The mean return is 20% here and 30% here, and standard deviation is say 10% here and 20% here. Fine. Okay. So it may happen that I put my money today and I have got a negative return in the next year, because it can go plus minus 10% on an average. So we can even go, we don't know, like it's like stock market, we can't see the bottom. So when you are investing, we think that the stock has given 30% return over the last 10 years, so it's a good stock. Fine. But it may happen that next year it may give minus 20% return also it can give. But if you hold the stock for a long period of time, it is going to give you a mean return of 30%. The chances are, very good chances that you hold a stock for 5 to 10 years, it will give you 30% return. If the main characteristics of the company is not changed. Fine. If the company is doing the same business and the company has management changed, the economy can go up and down. Stock volatility can be there. Okay. But the return is going to come over the time. Maybe you're unlucky that the stock went down in the first year itself when you bought it. Is that okay? Is that clear? So this is called basically the total risk, which is measured by standard deviation. Now you can eliminate one of the risks. You can eliminate company specific risk. Suppose I want to lower down my risk. You can do it. How do you do it? By investing not in one stock, but invest in portfolio. At least 10 to 15 stocks or 20 stocks at the most you can invest. Now when you invest in large number of, let's suppose I invested 1 lakh in Maruti and it came to 50,000 rupees in a matter of just a week because they were style. Had I invested 5,000 rupees in Reliance, Maruti, Colgate, Infosys, then I would have not lost that money. Because of Reliance is gone down, maybe Infosys something good has happened, it is gone. So because of the company specific risk gets cancelled out. Some stock goes up, some stock goes down. So that means neither I can make any gain or loss because of the company specific risk. If I have a portfolio of say at least 10 to 20 stocks. Is that okay? So I can eliminate the company specific risk. But then what risk I am having? Market risk. And I want to have a risk. Because if the risk, then only I can make money. Otherwise, I can't. Then I would be like investing in a fixed deposit where then I don't have any risk as such because there is no volatility. Okay. So I am just riding on market risk. Okay. Now market risk is measured through a statistical measure called beta. So I am, for me, the beta is important if I am invested not only in one stock but in many. Like when I am in mutual fund, because mutual fund is investing in many stocks, 10, 20, 30, we'll see the portfolio. So beta becomes more relevant also. Those transactions have its own relevance, okay? Fine. It's not that I mean, we look at both the risk measures. Now, what is beta? There are formulas, actually statistical measure, way through which we can calculate beta. And maybe that, I don't know whether you're studying how to calculate beta in one of your, I mean, this semester or maybe next semester. Have you studied? No. No. So beta is basically, I'll just give you a thumb rule. Now there is something called lifting, which you don't know. There is something called Sensex. If the Sensex goes on a lift, and a particular stock goes up by 50%, Sensex falls by 10%, and that particular stock falls by 15%. So that means that stock is more volatile than the market as a whole. And beta is 1.5. We take the return of the stock divided by the return of the market. Okay, we'll get a figure of 1.5. So market has beta 1. So either a stock will be more than 1 or less than 1. So beta can be either 1.25, 1.3, 1.6, or it can be 0.5, 0.3, 0.2. So, or we can assume that if the market goes up by 20%, your stock goes up by only 10%. Then what should be beta? 0.5. Okay. Now, statistically, it is calculated, like covariance versus the variance. Covariance of the market and the stock and variance of market. So this is the statistical formula to calculate the beta. Okay. A thumb covariance of market and stock. That means how the market, how the stock behaves with the market. So this is called the covariance, and this is the market. Okay, fine. Is that okay? So this is a statistical. I'm not going into the statistical, formula further, but I'm just saying. Suppose if I say market versus market, then it becomes the variance. Upon variance, so it is 1. So it becomes, variance of the market and variance of the market. So variance of market is 1 always. Okay, जो सेंसेक्स है उसका बीटा 1 है, निफ्टी का बीटा 1 है. Any index will have beta 1. So any stock will be more volatile, or less volatile compared to the baseline, which is the market. Okay, is it clear? So you are putting your money. If the market is, just reviving from a recession to a boom time, invest in high beta stocks because you will get a better return. I'll just say, if suppose the market is coming out of a recession from a normal situation to a boom time, like it's happening now, invest in high beta stocks. It will give you a higher return. But they are all riskier. Riskier means it can give you upside, gain or a downside gain both. Risk doesn't mean in finance, risk means you earn more or you lose more. Okay. So if you are in a situation where the markets are, starting their journey and the economy is going to do well, the Indian economy is going to do well, it's already doing it well from last 1 year. So buy stocks which are higher beta. But when the market is sliding back, invest in low beta stocks. Okay? Because that time, your portfolio, so you should have a combination of low and high beta stocks, both, to capture, bring stability in your portfolio. Now, Hindustan Unilever beta is close to about 0.3 or something. So I'll just show you, So I say beta. Okay. So I go to and calculate C beta. of Hindustan Lever. So this is Hindustan Lever. The site is in front. Just look at the site name, and you can just go to this site. Or if I can just give you the copy, this thing. Okay, just look at this. I'll share this. Okay, this is getting recorded, so don't worry about it. So here you will find the beta. So 1 year beta, 2 year beta, and 3 year beta. Okay. Mera bhai jara. Okay. So it is giving you various betas here. For any company, we know, look at the beta. Levered beta, unlevered. So there are two kinds of betas. Fine. So company who takes more loan, it's called leverage. Okay. Leverage means more loan. So without loan and with loan, you can just think about that. So leverage beta is whatever loan company has taken. Now Hindustan Lever doesn't take any loan as such. So normally levered beta and levered beta will be almost same. Okay. Reliance may have higher levered beta, and now unlevered beta. Unlevered beta is the business of the company. The business kitna risky hai. Now business can become more riskier if company has taken more loans. If you take more and more loan, your company becomes riskier because you have to service the loan. And in case in a bad time you will not able to service, you can go bankrupt. Okay. So this is also called asset beta. Unlevered beta is called the asset beta. वो asset जो है company का वो business क्या है? So this is point, now it is having 0.29, almost the same. So it is below 1. So Hindustan Lever is low beta stock. Fine. Now we go to a stock like for example Reliance. रिलायंस इंडस्ट्रीज दिखाया आपको कहीं? हाँ यार, हाँ लेकिन जब नीचे आती है ना मार्केट, हिंदुस्तान लेवर गिव्स द बेस्ट रिटर्न्स. Fine. Because your portfolio, because people start hiding in Hindustan Lever, people start buying Hindustan Lever. So instead of because your returns get magnified that time. Okay. Fine. So look at for example beta of Reliance Industries. It's about levered beta is 1.17 and unlevered beta is 1.09. So this page is called WW in front. Just say नहीं, money fund control में नहीं है. Of course, you can go to Yahoo Finance. There are many places you can get this beta, but this was the best site I found. मिल गया आपको? अच्छा, just have a look. I'll just share you the. What I do is I shared this link. Okay. हाँ, debt included. Okay. Now, just to give you some more thing. Levered beta, unlevered beta. Unlevered beta is the company itself. What kind of business the company is doing. Okay. Company is in airlines business. Okay. Hotel business, they will have higher beta. Company which is in FMCG product will have a lower beta. Now, apart from that, how much a company takes loan or how companies, there are two kinds of leverage which you are going to study, maybe in one of the semester. There are two leverage, operating leverage and financial leverage. Okay. Now, operating leverage, financial leverage is the loan. Operating leverage is what is your fixed cost compared to your total cost. Just to give an example, my son is doing a business where 90% is fixed cost. Okay, fine. He's paying 5 lakh rupees of rent, another 2 lakh rupees of salaries, so 7 lakh, and 2 lakhs there variable cost is there, which is by buying vegetables and other things, and they're making they're organizing parties also and serving people there. So 7 lakhs is fixed cost. If their sales is 7 lakhs, they don't make any profit, isn't it? The moment they suppose assume that 100% cost is fixed. Assume for a very simple reason that all the cost is fixed. Suppose the cost actual cost is 7 lakhs for doing the business of my son. 7 lakh, no variable cost. Up to 7 lakhs there will be no profit. The moment the sale goes to 8 lakhs, how much profit they make? 1 lakh. So that means 1 lakhs increase in sale, 1 lakh increase in profits. But if there is a decrease of 1 lakh, then the profits falls to 0. If the sale goes to 10 lakhs, they make a profit of 3 lakhs. Because everything they've spent the money, they don't have to spend anything to business. So a company which has more fixed cost and less variable cost is also a more risky company. Okay, because it is risk to, because if the company is doing well, profits will magnify. If the company sales come down, its profitability will come tumbling down. Okay, fine. So a company which has just the reverse, more of variable cost and less of fixed cost, is less riskier. So the levered beta assumes two kinds of things. One is the debt, the amount of loan the company is taken, and what kind of business, what is the fixed cost versus the variable cost. For example, a telecom company. Telecom company का major cost fixed होती है. All towers and telecom equipment, they put it and they have to just buy a SIM and sell a SIM to the people. Okay, use a channel partner to sell your SIM. So you pay some commission to the distributors कि ये बेच दो. So their variable cost is very less and they spend all the money upfront. Fine. And when the economy is doing well, they start making good profit because they have spent everything. They have a network to take care of, say, for example, 1 crore subscribers. Or अभी उनके पास 75 lakh subscribers है. Till 1 crore subscriber, they don't have to spend any money. So their profits are going to magnify. A classic example was during COVID time. COVID time, there was a lockdown. Almost nil activity. So at that time, when the lockdown was lifted, all the market doubled. Market was 35, around, I think, say 30,000, and it immediately touched, after 1 year, it touched 60,000 level. Now it's close to about 70. Within 1 year, the market doubled. All those companies which had, which were having operating leverage, more of fixed cost, because everybody had, their employees there, nobody turned down their employees, all the cost they have spent. So they, their profits also doubled. The moment the lockdown was over, they started making good profits because they don't have to spend any money. So the company which was having high operating leverage, they bounced back much faster. They became double in a matter of just 8 to 9 months. Is that okay? So operating leverage and financial leverage, there are two kinds of leverage. More operating leverage, that means more fixed cost, more loans make a company more riskier. Okay, fine. So this is all. So you look at this leverage. So beta. Is that clear? Any questions है? आपका पास question है? वो दो माइक दे सर. हाँ. हाँ. See, there are two kinds of. हाँ. एक होता है unlevered. Unlevered is the business. Unlevered is the business without any leverage. Like what kind of business you are doing? That is your unlevered. Now, unlevered beta will, unlevered business will be the business itself. Okay, and levered beta would be. I'm just thinking. Yeah, unlevered beta will be the business plus the operating leverage, and levered beta will be the how much financial leverage you have taken. अब जब आपका business है, आपका business ही ऐसा है जिसमें कि like for example accountancy firm like KPMG or Price Waterhouse, where all the cost is the people there. So they have more fixed cost, isn't it? Their business is like that. So that means unlevered beta will be, or the asset beta will include the business, and the operating leverage is part of the business, isn't it? Because how you are managing your business, okay? The other part is how much loans you have taken. So that is called the levered beta, okay? So the levered beta mein hai, that takes care into account your financial leverage. Up, yeah, we got it now. Sound like it? Okay. Is that clear? Any other questions? Have you followed this asset beta?
Yes.
So what is asset beta?
Sir, the asset beta is the unlevered beta. This is basically solely the company's business. The beta which comes out of the company business.
And the operating leverage is part of your business only.
Yes, asset of the company.
हाँ वो asset beta का unlevered beta तो the operating leverage is part of your business. The business this thing profile. And levered beta is how much loans you have taken, how much debt equity ratio you have. A company which has taken a more debt to equity ratio will have a higher uh, financial leverage.
And more the operating leverage, more the fixed cost, riskier it is.
Riskier. So both the leverages, operating leverage and financial leverage are riskier. Higher the operating leverage, higher the financial leverage. If the company has, it has a business which is risky itself, if it takes more loan, its beta will shoot up. It will become more riskier. If the company is already risky, the business is already risky, and company borrows and borrows, so companies become more riskier and riskier. Okay, and the stock price is not going to go very high. Fine. Is that okay? The stock price is not going to very high. People are not going to buy because the people think that it's a risky business. Fine, fine. So that is thing. So we'll come to that again.
In Adani's case,
Yeah,
in Adani's case,
yeah,
he got very high amount of loans,
yeah.
and but his stock prices are going quite high.
The same question was asked, I think, in one of the earlier class also, that they have more loans, but they're again, what happened when there was a scare? Their market cap fell down by 50% because their stocks are going, because the businesses are very profitable. What they are doing, because for whatever reasons, because they have political kind of a connections or whatever, I mean, because of their business, and it's well diversified company, so maybe the asset beta is not very high, it's only the leverage beta. Okay, then what we do is we take one more step. Just listen to me. There's something called net debt. The company Adani might have borrowed a lot of money. If the company has lot of cash reserves with it, money is suppose company has taken 1 lakh crores of loan. Suppose Adani has taken 1 lakh crore. But they are having 50,000 crores of cash and cash equivalents. They are valuing is that loan. Just look at the loan. Like Reliance, if you look, I just show you Reliance. I will go to Adani also, but let's go to, say, for example, let's go to Screener and let's go to Reliance. Okay, let's go to balance sheet. Now, how much loans they have got? Look at this figure, okay? 3,16,000 crores of loan Reliance has in last quarter. And look at the cash reserves, other assets. Cash equivalents are how much? 68,000. So this minus 68 is called the net debt. Right? Sometimes the debt may look very high, but if Reliance wants to pay, they can pay 68,000 in one stroke.
Something like that, you taken a loan, but you still got money.
हाँ, you still have money in hand, yeah. आपकी एक पॉकेट से आपने लोन लिया हुआ है, एक पॉकेट में बहुत पड़ा हुआ पैसा. Fine. So this is called the net debt. So the net debt situation doesn't look very bad in this thing. Okay. So we can even go. We'll see Adani later on. I don't know, because Adani has so many companies. Okay. So let's come back to this. Okay. Let's come back to this risk. Now, huh. Hmm. Yeah, yeah. Cash equivalents. 68,000. हाँ, there's a big, मतलब फिर भी difference है. But they sitting with almost like what 20% they can pay off by by their cash itself. I'm saying more. Which one? 20%? No, no. Yeah. Okay. Now just look at this. What is their debt to equity ratio? 0.42. Is that okay? 0.42 means 42 paisa debt, 1 rupee equity. Which is more, equity or debt? Equity is more. Even borrowing a lot of money of 3.5 lakh crores, their own money is almost 2.5 times than borrowed money. Is that okay? Which is a very good this thing. And look at one more thing, okay? एक चीज और देखो आप. इससे पहले लोन कितना था? इससे पहले लोन कितना था? 0.42 है, तो 1 डिवाइडेड बाई 0.4 कितना होगा? 1 रुपए इक्विटी, 0.4 डेट. सो हाउ मच यू गेट? मतलब 2 से ज्यादा ही आएगा ना फिगर, 2.5 ही आएगी फिगर. ओके, नाउ लुक एट वन मोर थिंग सर, प्लीज इसको देखो. व्हाट वाज द बोरिंग लास्ट ईयर
451.
and what is the borrowing now? So they have reduced drastically. So I told you the Reliance strategy is basically, they have actually issued equity to foreign companies, like Emirates. They have put the money into Reliance in the last year, and that money which came to Reliance as a equity, they paid off the debt. So this is the way Reliance has been functioning. They start the business, grow it to a level, increase the valuation of the company, and sell some stake to a foreigner or some stakeholder through a private placement. And whatever money they get, they pay off that as loan. So over the time, they have not allowed the company to become highly leveraged. Okay, fine. Because it's a company which requires, it's the biggest company of India, and present into 6, 7 kinds of businesses, and into petroleum, crude, and other products. So it requires a lot of money. All the money cannot be financed through equity, so they have to borrow. So they borrow the money and then pay off over the time. So this has been their strategy. So the company is quite healthy. Financially, is considered to be very healthy. Okay. Now let's come back to this. Let's come back to this, okay, to explain that. Now we have standard deviation, we have beta, now we have the Sharpe ratio. The first one is called the Sharpe ratio, which is nothing but return divided by risk. Okay, so the formula of the Sharpe ratio is like this. Sharpe ratio. Sharpe ratio is the return, the mean return of the fund. Now, mean return, they have calculated on the basis of the last 3 years return of the fund minus the risk-free return divided by the standard deviation. Okay. So this is the formula for calculating the Sharpe ratio. This is the standard deviation. So this is the risk and this is the return which the fund is giving you. Now they say that if you invest in say fixed deposit or divided by standard, this is standard deviation. Okay. This is the return which the fund has given you over the last, and this is the risk-free return. You have two choices. If you want to invest, you can invest in fixed deposit where you get 7.5% return. Okay, but when you are investing in equity, you're getting more. So your return from the fund should be more than this, isn't it? तभी तो लगाओगे पैसा. Why you are going to invest into a stock or a fund? Because it should give you a more return than the risk-free return which is available to you in form of a government bond or a fixed deposit. So it says, I'm going to minus this because this is the return you would have anyway got by putting your money in a fixed deposit. So इसके ऊपर की return आपको matter करती है, isn't it? The return which you are getting more from the equity market or the fund market is which matters to you, and you should be able to beat that because risk-free return is nothing but the inflation return. It should beat the inflation. Normally, the fixed deposit return is very close to the inflation. If the inflation is about 6-7%, then the fixed deposit should be 1% higher than that. Okay. So mean return minus this thing. So this is called the standard deviation. This is called the Sharpe ratio. Now, higher the Sharpe ratio, better it is. So I can now, I can sort on the basis of large to this thing. So which is the best stock, which is the best fund in terms of Sharpe ratio? Nippon. Because it is having 1.18. Is that okay? Fine. Now we come to trainer ratio. So trainer ratio is like this. Instead of this, I take beta. Okay. So here I take beta. Okay. So वही चीज है return per unit of market risk. In first it was Sharpe ratio was return per unit of total risk. Okay. So now we can even sort it on the basis of trainer ratio. So largest small. So again we get Nippon. So Nippon is getting in both parameters, whether it's Sharpe ratio or whether it's trainer ratio, we are getting Nippon coming at the top, followed by HDFC top 200. Is that okay? Fine. Now we come to Jensen Alpha. Now, what is Jensen Alpha? ये हो गया आपको पहले पता चल गया आपको? This is clear? Trainer ratio is, we divide by beta instead of standard deviation. Same rate, the same formula, okay? We call it now the trainer ratio. Trainer.
It needs to be matched. The trainer ratio.
Huh. All these two ratios, which are fund is having the highest, will be better. Whether it is trainer ratio, whether it is Sharpe ratio, the fund which is having the highest ratio is a top performing fund. Okay. Now look at this. This is giving you the last 3-year summary. You don't have to look at 5-year, 10-year, 15-year return. Look at this. So the top is Nippon, followed by HDFC top 200, and then ICICI and Quant is nowhere coming here, isn't it? Quant जो दे रहा था वहां पर वो गायब हो गया है कहीं. Quant is not there. Maybe it is not coming into the classification of that. The period which they, because it is only there from last 1 year. हाँ वो 1 साल से ही है इसलिए उसकी रेशो निकली नहीं अभी we can't say with conformity that that will do well. Okay, so that has been taken out of the our analysis. Is that okay?
The four new funds are not there.
हाँ वो जो 4 नए फंड है वो नहीं है क्योंकि उनका 1 साल का ही ट्रैक रिकॉर्ड है. So on 1 year track record we can't judge the fund whether it will do well or not. Just 1 year a flip or something like that. Fine. Now the third one is called the trainer ratio. Sorry, Jensen Alpha. Now it's called Alpha. The first was called Beta. Now it's Alpha. Alpha is how much more you are getting. Your fund manager is going to generate more than the benchmark. जो benchmark है like Sensex or Nifty, for example, for large caps it will be either Nifty or or BSE 100 index. The top 100 का index है is called BSE 100 or NSE 100. This is an index. So now Jensen Alpha would mean here 6.6, which means it is giving 6.6% more than Nifty. For example, if Nifty has given you 15, it is giving you 21.6, we can assume. Okay. Or Nifty has given you 13, then it is giving you, now this fund is giving close to about 18, 19. So you minus 6, that is a return of the benchmark. Okay. Fine. So here the formula would be, the fund average return minus the benchmark return is equal to alpha, or we can say Jensen alpha, ALPHA. So alpha is this, or we can say Jensen alpha. So Jensen alpha is fund average return minus the benchmark return. Suppose it has beaten the Nifty or the Sensex or the 100 index. So benchmark means, suppose on an average how much the market has given. Market ने आपको 15% return दी. Okay. Now there are 30 stocks in Sensex and there are 50 stocks in Nifty, isn't it? So the out of that 30 or 50 or 100 stock, the fund manager has selected the best out of them. Okay, fine. Because that return of the market is average of entire 100 stocks. So he has ignored say 30, 40 stocks and put the money in the balance of the stocks, which has given you the high. Or he has put only the money in 30 stocks and ignored the rest of the 70, which he thought was going to outperform all the other stocks. Is that okay? Which?
You said out of 50, the average is also. Which 50?
हाँ देखो निफ्टी 50. So निफ्टी 50 का तो कॉम्पोजिशन हमें पता है. ऐसे ही BSE 100 का भी कॉम्पोजिशन है. सो वील सी द बेंचमार्क.
So benchmark return
हाँ.
appears somewhere.
Okay, so I'm just going to look at the benchmark here. Okay, let's see what is the benchmark. So let's go to the large cap again and go to the returns. Okay. Go to Nippon. Okay, for example, go to Nippon. So look at this. Look at this. Okay, this scheme has given 25% return, and S&P 500 stock index has given 15. Let's say 3 year or 2 year, for example. So this has beaten the benchmark like this.
So alpha is 8%.
Alpha is 8. तो 3 साल का निकाला हुआ उसने. That figure has been calculated. This is alpha. Is that okay? 5 year alpha देखो आप. So आप जितना लंबा चलते जाओगे ना, alpha reduce हो जाएगा. Because on a long term, because this is a cyclical, funds are cyclical in nature. Some stocks which are not doing well, they start doing better. So over the long period, the everything will move towards the benchmark. Okay.
So does that mean, sir, it is better to be invested in ETFs for the longer, if I have invested for 15 years,
हाँ.
better to go for ETFs?
हाँ, they are more safer, ETF or index funds, whatever. बट आपने अगर 5 साल का होराइजन है तो फिर निपॉन तो 5 साल में बीट ही कर रहा है ना. दैट्स योर ओन चॉइस ना. हाँ जी. ETF इज एक्सचेंज ट्रेडेड फंड्स. विल बी कवरिंग आफ्टर द ब्रेक. अभी ब्रेक होगी. ठीक है. ओके. सो हैव यू ऑल फॉलोड? वाज इट गुड? मैं चलो ठीक है.